I am Brendan Yurik, CEO of Electric Royalties. We are a clean energy royalty company focused exclusively on 9 different clean energy metals. We went public back in June of 2020, and we've acquired over 73 different assets, including our 41st royalty, which we just announced on the producing copper gold mine in Chile. We are really poised for a lot of growth this year, and have about 35 different assets which could contribute to our cash flow next year. So we are very, very excited about that, and even in a tough market, we're very excited about next year.
Okay, so that's a big statement there. 35 projects which could potentially contribute towards revenue. I'll come back to that. I need people to kind of get aboard with what your thesis is. Have you been right? So explain your thesis for us and the why, and where's the data to back that up?
Yeah, so our thesis since the beginning has been that we see 2 decades of opportunity at least in the clean energy metal space. You have a lot of different drivers for that. Electric vehicles is the big one, which everyone talks about. Everybody has an opinion on that. And for me, that's, a piece of it for sure. But you look at the energy storage market, those are essentially batteries for cities. And the first ones of those are just actually getting installed in the US. So that's another big demand driver you haven't even seen really hit the market. Renewable energy. There's massive amounts of these metals required for all renewable energies. Renewable energy generation across the planet, hundreds of billions of dollars going into that. And so you're definitely going to see that demand increase as well. And that's a big part of it. But really everything that we use today, requires these metals. And the fact of the matter is, from a supply perspective, we don't have enough of them. And because you've had such a huge period of underinvestment in this space, and your average development timeline is about 15 years, it's really hard to overcome that supply demand imbalance that we see coming. And so, this is a long-term outlook that we've had. I think we've been buying royalties at the perfect time, very, very low cost relative to what you see in other royalty spaces. And part of that's because we have no competition. We did the first graphite royalty financing ever done. One of the few groups out there interested in tin, which, you look at tin prices are up, I think, over 50% in the last, year or so. And so, we do think we're in the right space, and, we're definitely excited about the future. Low price environments like this that, kind of consist longer than people think. That just creates opportunity for us, like we are in the copper space right now.
Okay, I hear what you're saying, right? So everyone's been talking, EV, electrification of everything, even net zero is a kind of big driver of this for you guys. It kind of feels like the sheen is wearing slightly thin there on that messaging. Is the market right to think that? Retail is bored of that story? I mean, what are the actual drivers behind that that's going to sustain that story?
I think the markets are confused right now. And I think a lot of that comes down to, the Trump tariffs and what's the impact of that going to be. But, I actually think our thesis really has been to buy royalties on deposits in North America, Europe, and Australia that could be domestic sources of supply for these metals. And so when you look at that perspective, I think the security of supply situation is definitely being brought more in focus. China's getting a lot more heavy-handed about what metals are going to be putting export controls on. And so I actually think that, the incoming administration is going to put a bigger focus on actually having these metals at home. And almost all of our projects, all of our assets are in North America, Europe, Australia, except for one. So I think we're actually set to benefit greatly from this. We've been picking up the best royalties on the best assets for these clean energy metals, in these spaces. And so we actually think this is going to be really positive for us as you see things unfold over the next few years.
So you're pro tariffs?
I'm pro tariffs. I think it's an interesting call. I think it's really interesting to note that a lot of people have already started to reduce their imports from China. You're already having a lot of the benefit effect of what he was threatening to do without ever having to do it. So I do expect that also that is going to work itself out. I think it's a negotiating tactic. Ultimately, I think the economy is going to start to get going a little bit more here as we move forward.
Is it a better environment, kind of ex-China? Aren't these items going to be more expensive to produce? We've seen, and I've discussed it multiple times with multiple CEOs about, the time frame from discovery through to production of most metals has gone from, say 12 years to, nearly 20 years. Are we going to just price ourselves out of the market with tariffs?
That's a good question. I think tariffs, I think this is really going to be a shorter term thing. And so, when you're looking at timelines of 15 years, I don't think it really impacts it significantly. But yeah, I think it would be interesting to see. I mean, China still dominates most of these metals, right? They produce most of the world's graphite, most of the world's tin. They've got their hands in nickel, obviously, in Indonesia, and I'd say they probably control that too. They do most of the lithium processing. They do most of the manganese processing. So I do think that security of supply situation is going to be a real big driver for us. And we always kind of saw that coming. That was one of our original bets, that it would be important to have these, metals produced at home. And when you look at the amount of deposits that actually could fit that bill, we have royalties on most of them. We feel like, because there aren't that many. And so the ones that there are, it's going to be a big driver for development.
Okay, and so I'm gonna dumb this down for some of the audience will understand all this, but there'll be some new people in here. Right? In terms of the royalties that you have, take any royalty, for example, that you have, and say, right, here's how the economics break down. Whatever you want, pick one, but break it down for us. I'm trying to work it out. What do you walk away with in different price environments? Okay, if it's a low nickel price environment or high nickel price environment, how do you benefit?
Yeah, so we are really diversified across 9 different clean energy metals, so we have exposure to all of them. We're not too heavily into any one metal. Right now, we're kind of making a big push into copper, tin, zinc to kind of grow our portfolio there. But we have some royalties, right? Like 73 assets, and you look at a royalty like Battery Hill, which I think I brought up before. That's a royalty. It's got a 40-year mine life. We expect it's going to pay $5 to $7 million a year in royalty revenue back to us once in production. And it's really the best manganese asset in Canada, for sure, bar none. There's really only 2 in North America that we have any interest in. And so, that's one that if prices go up on any of our royalties, our revenue goes up exactly proportional. So if manganese prices doubled, our revenues from that would double. And like I said, so that's just one royalty out of 73 in our portfolio. With a market cap of 22 million, you're looking at that against one royalty's cash flows of, north of 200 million. And if prices were to double, then that would double. And so that's really the big upside case. I think right now what you're seeing is really the bottom of the market. We're trading at historical all-time lows. And prices are down, but I think you're really finding a bottom, where we're at today.
Because what are you getting percentage of what the sale of what?
Yeah, so most of our royalties are gross revenue royalties, right? So we buy royalty interest, which is a percentage of the cash flows from the mine when they're in production, and that really sticks to the project. So no matter who takes that forward, puts it in production, they're going to have to honor and pay that royalty. And so in the case of battery mineral. In the case of that one, it's about 2% gross revenue royalty. So 2% of right off the top of the revenues from that project. Most of our royalties are gross revenue royalties. We did that by design, and that's because we're one of the few groups that actually goes out, creates these royalties new by offering financing direct to these companies. So right off the top, very easy to calculate.
Literally, if the price doubles, you get double.
Yeah. Exactly.
Not more.
Double.
Okay.
Yeah.
Okay. No. So I'm just trying to work out if there's a sunk cost. There's a sunk cost of these things.
Cost, right, is zero on a unit basis. We have a very low G&A. It's about $1.5 million a year. So the revenues that we get from all these different assets, you essentially just spread over that G&A. And so it's one of the great things of the royalty business model, for sure.
Okay, so that's how you're calculating it, and that's so people can kind of work out what's going on and how they benefit. Okay, let's kind of maybe get into the portfolio, because the name of the game here is revenue. Okay, that's when you're kind of nascent, when you're young and setting up. I guess you're spending your time trying to get deals over the line to put you in a position to get revenue. So phase 1 for you bought a lot. With different timeframes in terms of revenue, like likelihood, and obviously as you go through time, commodity prices fluctuate a bit. Some which may have seemed exciting at the time, maybe have come off, or maybe they've gone ahead. Who knows? But the point is, get a kind of blended approach. That's what you've been focused on to date. I want to hear when we start benefiting from all of that work that you've done. I want to hear revenue, timing, etc. So when does phase 2, the money bit, start?
Yeah, so I think we're entering that phase now. When we got started, to grow creatively and to build some value for shareholders, you kind of have to make some bets that are going to grow some value over time. And we made a lot of those bets, bets that would be a little bit earlier stage, 3 to 5 years from production, but projects that have raised 70 million, 150 million dollars, since we acquired those royalties. So a lot of those royalties are now, we bought them, they were 3 to 5 years from production. They're now 1 to 3 years from production. And so we've got a really good development portfolio of those assets. And we've been picking up near term producing royalties now as well for the last couple of years. And so this recent deal, it's producing copper gold mine in Chile. It's got a fantastic private equity partner, the Yorktown Group, behind it. They're the biggest shareholder, biggest project lender as well. And so, we're really excited about this. It's produced 10 years historically under Glencore. You look at where copper prices are now, where gold prices are now, significantly higher. And so that's going to immediately boost our cash flow profile. And so we're excited about that. We just announced that within the last week. We're actually going to be able to fund closing of that with our acquisition facility with Stefan Gleason, our biggest shareholder. And so that's a big one and definitely going to help add to it. And then, if you look back at last year, we just acquired this year, we closed on it, the lithium portfolio. So of that, there was a number of properties optioned out to third parties. So we still have 29 properties optioned out to third parties. We expect revenue back from that. So I think we're forecasting around 850,000 or so for the next 12 months. And that's across 29 different properties, multiple different operators. And then we've also, got a number of royalties that could come back into production or enter production next year, including our Panuta tin mine royalty that's shut down from permitting issues. They're going through some financing stuff. But that's Europe's only tin mine, only producing tin mine. And, tin prices are up about 50% over the last 12 months since they shut down. So we have some hope there. You look at our Middle Tennessee zinc royalty. Trafigura just spooked the zinc market a little bit, drawing out some inventory from the LME. I think that just shows how tight the zinc space is. And when they shut down, it was really because of low zinc prices. So zinc prices have come back quite a bit. They have germanium and gallium at that mine, which I know is a big kind of consideration for the U.S. right now because China's done some export controls on that. But that should definitely come back in production, at some point here in the near future. We have our Graphite royalty. That was past producing, operated for 18 months continuously. They are now in the process of trying to raise the project financing to get back in production. But that would be a very nice royalty for us, over the next kind of 3-4 years. Really help our cash flow profile. So we're hopeful on that one. And then we also have our Oche lithium royalty. It's part of the producing North American lithium hub. Sayona Mining is the operator. They're just in the process of merging actually with Piedmont Lithium. And in the feasibility study they had, Oche makes up about 33% of the blended ore to that project. And so, we're also hopeful that has a chance to come into production as well next year. And so that's all, different sources of cash flow that we have coming back at us next year. I should also mention we also have advanced royalty payments on Biscuit Creek as well. So, I think our cash flow potential and the diversification of cash flows for next year is definitely by far the best it's ever been for the company in terms of potential and diversification.
Okay, so before we kind of carry on down that kind of revenue stream conversation, I just need to understand, the kind of risk management side of the cash allocation, right? So, because like I say, you spend a lot of time buying stuff, you learn a few things along the way, got a few things right, got a few things wrong, I'm sure, right? But here we talk about the kind of on the copper thematic. You said you're quite pleased about that, but you've kind of announced one project and then announced, well, you're not going to go ahead with another stream that you're thinking of doing. What was that risk assessment?
Yeah, well, definitely due diligence, right? We had limited capital available, so we kind of have to deploy it where we want to best. And, I think just overall, this was the better opportunity for us. They've got a fantastic private equity group. So, funding obviously being one of the biggest challenges, I think, in the mining space, knowing that there's some funding there if they need some more. Is really a big indication. We kind of handpicked that one, quite frankly, to do the Punitaki royalty with Battery Mineral Resources, something that we've been looking at for a couple of years now. And so, it's not something that happened overnight necessarily. We've been doing due diligence on these and technical due diligence for, many months now. And that's the result of it. So, not every project that we look at or sign up, we push ahead on and ultimately transact on, we do have a very lengthy due diligence process.
Okay. I'm going to try and keep this conversation simple, because I think the difficulty with royalty companies is people look at these royalty companies, look down the portfolio. They've got to do an assessment of each of the companies that you have royalty on or stream on, and try and work out whether they think that's going to work or not, right? And then make an assessment as what the timing could be, right? There's a lot of work involved. I know brokers who can't be bothered to frankly go through that process. So keep it really simple with people listening, watching this, listening to this, is you've got a lot of companies you've just described who potentially could be revenue generating next year. Just listening to that and to being aware of, the sorts of numbers you've talked about there. So that could be, I don't know, let's say just for shits and giggles, $5 to $6 million next year. $5 to $6 million puts you in quite, good place compared to some of the other names out there. But you're a smaller outfit. And I'm just saying this. I'm not saying I think it's definitely 5 or definitely 6. I'm sure you can't do that either. But I'm just saying, if it was, why is that a better place for you than, say, some of the bigger names who are valued more significantly more than you are? Why is it better for you?
Yeah, no, I appreciate that. I mean, there are groups out there that are running around that kind of cash revenue number, and they are trading at multiples, 15, 20x where we're trading at today. And, I'd argue that our development portfolio is actually a little bit stronger, because we've been actively picking up a lot of these more longer term 3 to 5 year projects. And we've been doing that now for 3 to 5 years. But if we were to get to 6 million and, some of those comps out there, our G&A structure is way lower. We're about 25% of the G&A cost of them. I think the big difference really is just listing, having a New York Stock Exchange listing, having a big private equity group behind, but the value prospect, between us and some of these other groups out there, you're talking, like I said, a significant multiple in terms of valuation that we could achieve next year.
Right. But what does that do for you? So, okay, so that's the point. Well, what it could do for you in terms of margin, because it less cost. And maybe what that could do for retail, because they may say, well, okay, that's great. You got the revenue, you started to do what you said you're going to do. What does it do for your access to capital? I know you've got some credit lines, but it's kind of limited. But to do the sorts of deals which you're going to want to start doing, what sort of kind of balance sheet profile do you need to demonstrate to them to make them feel confident to give you the money because you know what you're doing?
I think we've been building that, to be honest. So I know there's a lot of money out there that definitely wants to deploy to this space, and it's been really slow in coming. But I do expect that we're going to have a lot bigger capital coming to this space that's going to want to participate with us, whether it's on a kind of co-investment basis or not. But I think that'll probably be one of the bigger routes, to be honest, where capital comes in. They will want to co-invest in these assets, and that they will actually put up most of the capital to fund these acquisitions. So I think the actual real key thing that we've been building here is a knowledge and a skill set in doing royalty deals in the clean energy metal space that other people have not been doing for the last 5 years. So I do think we're going to be able to be in a unique position to attract some of that capital to help us grow. But definitely as we get bigger, as we get cash flow positive, as we go through some kind of corporate M&A growth, next year, we are going to get bigger. We are definitely going to have, more liquidity as a result of that. And we should start to get re-rated like some of our peers out there in the market.
Okay. Do you think people kind of, like, retail have been bid up real good? Why should people buy royalty? Well, let's say they stick in the mining space and derivatives thereof. At all, because it seems to be a mass exodus. Is why are royalties a better investment than regular, direct equities and investment into a company?
Definitely. I think the biggest one is diversification. You could individually invest in any one of our single operating companies, and if something goes wrong, your investment's going to go to zero. Whereas if you invest in us, most of our assets, none of them make up more than 10% of our value. We're diversified across 9 different clean energy metals. And so, the wins that you will get in that portfolio will more than offset the losses. But, when you have to actually pick an individual project, individual commodity, then you're taking a much bigger risk. And so, for us, the long-term upside is always there. You look at how much has been raised by third parties at no cost to us to move our projects forward, even in a tough market. And it's got to be over north of 600 million by now. And so that costs us nothing. We have no holding costs on these royalties. Our G&A are very low, so we can weather the tough times. And, definitely, keep doing deals and adding stuff that is going to benefit us greatly, as we move forward. But diversification has got to be the number one. Diversification and diversification of cash flows.
Do you think you've grown up in the last 3 years?
I was thinking about that today because we have been doing this now for a few years. Yes, I think significantly. It's been a grind, to put this portfolio together. We've been at it for, almost 5 years now, 73 assets, really bright future and definitely tough to be trading at where we are. But I think about the first time I came on here with you, and yes, I definitely think I've matured and grown quite a bit since then.
I was talking about the company, but we'll go with you as well.
Yeah, well, both of us. Yes, yeah. Side by side.
Good. Okay, well, I think we're kind of, just looking back at sort of an interesting process to get, from an idea and to executing on some of those things, and maybe now looking forward to revenue, and I guess still continuing to keep an eye on opportunities ahead. So, Brendan, appreciate your time today. Stay in touch. See you soon.
Thanks, Matt. Appreciate it.